the U.S. Federal Reserve has been keeping an eye on price levels ahead of its rate decision this week. And that's as inflation has been a thorn in the side for many in the U.S. throughout 2023. Now, the economy has also been dealing with the side effect of a series of interest rate hikes meant to ease those price pressures. William Denselow looks back on the economic headwinds of the past year.
Halloween has come and gone, but US consumers continue to be haunted by sticker shock. Year on year, consumer prices have fallen since hitting a peak of 9.1% in June 2022. But price pressures persist, their impact still firmly on display.
Inflation is a lot, and spending money on free time, sports and other activities have been affected a lot, yes.
I'm the broke 20-year-old who now has a full-time job, and yes, groceries are way more expensive.
Honestly, a lot of it is travel. We haven't been able to travel as much as we normally do.
Inflation has continued to be an unappetizing reality for diners this year. Price pressures may be cooling, but the cost of dining out at a restaurant remains elevated. For cash-conscious consumers, this has provided food for thought and impacted people's food choices.
You kind of look at why restaurant prices and, I think it has to come down to some supply chain dynamics, some other factors that might be behind that, but it has been a little bit slower to moderate than grocery. And I think that's why we're seeing some of a channel shift away from restaurants into other lower priced grocery channels.
To get inflation under control, the Federal Reserve put the US on a steady diet of interest rate hikes, raising them 11 times before settling, for now at least, on a target range between 5.25% to 5.5%.
This year's been a balancing act for the Fed, slashing inflation without slipping the economy into reverse. Many analysts believe the US will achieve a so-called soft economic landing and avoid recession, but not without some pain to the public.
Goldman Sachs is pricing in just a 15% chance of recession over the next 12 months and expects the economy to expand 2.1% in 2024. The central bank isn't expected to lower interest rates anytime soon, which could continue to impact sectors like real estate. Mortgage rates hit a more than two-decade high of over 8% in October, due in large part to elevated borrowing costs.
But as you can see walking in, there are a lot of modern details.
This three-bedroom apartment on Manhattan's Upper West Side has just hit the market at an asking price of $2.2 million. Realtor Alex Abrahamson says high interest rates have led to some price cuts, which benefit cash buyers. But the current economic landscape has closed the door for many prospective buyers.
It might essentially mean that you're going to, unless you have a big down payment, that you're going to be paying pretty expensive monthlies. And it's a harder barrier of entry for first-time home buyers as well. So I think those are a lot of the things that those mortgage rates can affect.
Heading into an election year, the fight against inflation and the state of the economy can have significant consequences.
If we continue to have high inflation rates, that the electorate believes that the economy is just sputtering along, that will work against the current administration. Historically, the stock market has done very well, however, in the election year of a first-term president.
Federal Reserve Chair Jerome Powell says he's not confident enough has been done to bring inflation down to its 2% target. US consumers hope he's wrong, and the money in their pockets will soon start stretching that little bit further. William Denselow, CNA, New York.